Hello, everyone. We're going to give some minutes until more people can join. So I guess around 3 minutes until we get started. I already see Andrea. Hello there.
Hi.
Well,
can I check if I can share the screen very quickly just to check everything's working well?
Yes. Let me give you permission. Now you should be able to share.
Okay.
We can keep it ready.
Perfect.
Okay. I think now I see myself in your screen.
That's it.
Perfect. All right. So as I was saying, let's leave 3 minutes, more or less. Always in these first minutes, many people join. So yeah, a couple more minutes and then we get started. I'll write it on the chat as well. Couple of minutes and we get started. Already 24 people that joined. More people had signed up, so I guess that they will join in the coming minutes. One more minute and we get started. Maybe you can already share the screen with the cover of the presentation, Andrea, and we can have it as background ready. Perfect. Yeah, if you put it full screen, I guess it's the easiest.
Give me 1 second, Jaime. In that case.
I guess if you just share the PDF and go full screen, I think it's Control L.
Okay.
So
there you go.
Yeah, I think we're ready. And it's 6:03, so I guess that some other people will join in the coming minutes, but we can get started. So, well, first of all, thank you very much for joining for this webinar, and thank you very much, Andrea, for your time with us. As I will explain soon, I think your feedback is going to be greatly appreciated, both from the startup point of view that you have been there, and from the VC point of view that you have been before and after the startup experience. So, well, very quickly on us, on the startup CFO, in case you don't know us well. I'm Jaime, I'm the CEO of the startup CFO. We offer financial services, fractional CFO service, or public funding consulting and stuff like that for early stage startups. We have already served over 300 clients. We are a team of 35 people, and we have an office in Madrid and another one in Berlin. Germany, it's a great market that we have been attacking since last year, and we have both offices, one in Spain and one in Germany, although we provide services to startups everywhere. In fact, Nauta is one of the very first VCs that I started having a good relationship with. I met Borja Breña, partner at Nauta, when I was working at my last job in a startup at GeoLink. And certainly a lot of things that I know about startup finance come from Borja and therefore from Nauta. So especially happy to have someone from Nauta here. And also, well, we are going to have Andrea presenting to us how they read a VC deck. And this is very important for two reasons. First of all, and I guess the obvious one, is let's see how to write a deck. Let's see how to present the information about our startup to a VC such that they spend enough time on it and then they say, let's have a call. Because 90% of the times or 95% of the times, the very first contact that the VCs have with a startup is just by the deck. And there is this crazy statistics, I don't remember exactly how it was, but it's like VC professionals, on average, they spend like a minute and a half or 2 minutes or something like that per deck. So certainly how to write it is super important. How to present all this information. You could talk about your startup for 5 hours, but you need to present that very briefly and in a very specific way, such that it triggers the attention from the VCs. But the second part, and it's way more important than that, it's how your startup should be to be appealing to VCs. So it's not just how you present it, but of course, if one of the things that you need to present is that you have a very big market to play on, then you should have a very big market. So for example, many companies come to us asking us to write the business deck, thinking that we are just going to put on paper what they have in mind. But in the end, we talk a lot about the strategy of the company. And we realize in this process of presenting the information that the startup really needs to get their homework done. And there are many questions that are not answered for the startup, not just in the deck. So I guess that we will go back and forth a lot around this concept of, is it about the company or is it about how to introduce it? So well, for the next hour, we're gonna have, well, first of all, like a brief intro of Andrea, like the typical CV, like tell us how you got here, and then the best practices they have from in Nauta to how to build a deck or what a VC is looking for. Of course, feel free to interrupt at any time. The more questions, the better. I will have the chat open in case you guys want to ask any question. So feel free or to use the raise hand function in Zoom or whatever you guys want, essentially. But yeah, the more dynamic, the better. And if you guys have more questions or like want to talk about your specific case or whatever, that's more than welcome. So once we're here, Andrea, typical CV interview question. And again, thank you for being here. What did you do? How did you get here?
Thank you for having me, Jaime. I don't see your face, so anything somebody's putting in the chat, just cut me and ask me the question, okay? Sure. So I studied business administration. I did internships in startups. I knew that I wanted to become a founder at some point, but I didn't have an idea. I didn't have money. I didn't have experience. So I thought that joining a VC would be a good starting point. And that's how I joined first Nauta Capital back in 2015 in London for 2 years. Then I moved to Nauta. I spent 2 years at Nauta as an associate, and I left Nauta by the end of 2018 to start my own company, MJoy. MJoy was a sexual well-being app for women with sexual dysfunctions. Women who had a sexual dysfunction and were embarrassed of going to therapy, they could download our app, and we had audio content in the app that we built with doctors, sex therapists, etc., so that women could work towards sexual well-being goals such as climaxing consistently, solving desire issues or pain, etc. That business, we scaled it to around 50K in monthly recurring revenue. We were a 20 people team. We raised 3 rounds, one with business angels, 100K, then one led by Nauta of 1 million, and then another one led by GME of 2.5 million euros. So I've been analyzing decks from the VC part, but I've also done fundraising before. So I'm going to give you hopefully both perspectives. And halfway along the entrepreneurship journey, our app was banned from advertising because we were flagged as a pornography product. And overnight, we couldn't spend any more money on Facebook, Instagram, TikTok, Snapchat, and that was like the beginning of the end. Last year, I had to fire all the team, and I managed to sell the assets of the company to a Danish company. And Nauta gave me the chance to come back to the team. I'm now an investment manager at Nauta since November last year. Again, very brief on Nauta. We're a B2B SaaS early stage fund. We've been investing for over 15 years. And we're currently investing from our fifth fund of almost 200 million euros. And we invest between 1 and 5 million euros in seed and Series A round. So that's a bit the background. And I will get started a bit with the presentation. As Jaime was mentioning,
well, hold on, Andrea. I just want to stop you and two quick questions. Well, first of all, one day we'll do a webinar on your Enjoy adventure. And what the hell? I didn't expect that ending. And that must have been like really frustrating from your point of view and with so many customers. Like, yeah, I find it crazy. So like one day I think we'll talk more about just that. Yes. But also I see many people asking me, especially from consulting, that they say, I want to jump into the startup world, or one day I want to start a startup. And they have the dilemma of whether to join a VC, so then learn a lot there and then a startup, or start a startup directly, or, and I guess you have done both transitions, VC to startup, startup to VC. So like, do you think that like adventure in VC really helped you for startups, or like that the other one helped too?
So when I was in VC, I was in VC for 4 years. We did like 7 investments. I had looked at over, 4,000 companies. So I thought I knew many things about startups. And the first day of operations, I realized I had no idea about day-to-day operations of a company. No idea. For instance, the day that we were launching the app to the market, like everything was ready, like the PR announcement, like the campaigns, everything was ready. And suddenly my co-founder comes and tells me, Andrea, but we don't have the screenshots for the app store. You need screenshots in order to upload an app. And I was like, fuck, I hadn't even thought of it. So it helped me in terms of strategy, the metrics I knew we had to hit for fundraising. It helped me a lot because I knew many VCs already. Like the fundraising at Enjoy has been great, but in terms of like operations and day-to-day, I thought I knew many things, but I realized I didn't have an idea. So my advice would be rather to join a startup if you can be the right hand of a founder or something like that. I think that learning curve will be much better for you if you want to become an entrepreneur in the future. That's my opinion. And I also think that another way to do that, but if there is an industry that you already like a lot, let's say I love real estate, I love pharma, I love fintech, whatever it is, the best way to identify a problem or something that's broken, it's actually working in the industry. So you could go to a very big company or a medium-sized company, work there for 3 years, get to know like different stakeholders, etc. And then you can try to solve a problem in an industry you already know, and you already have a network of partners, potential clients, etc. So I think that if I need to start a company again, that would be a way of doing that for me.
Again, I would have so many more questions, but let's focus on the topic. That's why
okay, people. So it doesn't matter how beautiful your deck is. Like we will cover like the main things that a deck needs to have. I'm bringing examples to actually say what's good, what isn't that good. But maybe I wanted to go like a step back, and it doesn't matter how good your deck is. As Jaime was mentioning, there are like certain things or certain boxes that you need to tick in order to actually raise money from a VC, okay? The first one, which might seem very obvious, but it isn't sometimes, you need to make sure that you're sending your deck to the right fund. For instance, in our case, we only do B2B SaaS, mainly in Spain, the UK, and a little bit in the rest of Europe. So I get many founders insisting and following up on me that have like a hardware device or that do e-commerce. They can have like the best company in the world. It's always going to be a no. So I would tell you, like, do a little bit of research and try to talk to the funds that you know that the investment thesis it is a fit with what you're doing. Or there are funds that do very early stage, some others that do growth investing. So make sure that you're talking to the right fund, because otherwise the no is always assured. Another thing which I find important, and it seems very obvious, but it isn't, is that we want companies that are addressing a real problem. So many times I see something that I call solutions in search of a problem. For me, a solution in search of a problem is when I suddenly see in a deck something like we're the Netflix of content marketing, or we are the Uber of cleaners, something like that. Every time I see that, I think, this seems like a solution in search of a problem, rather than somebody who has found a problem and is trying to build something to address that problem. So like actually having a problem and showing what the problem is it's going to be very important in the fundraising process. As you were mentioning, Jaime, a very big market size. I will show you how to do a bottom-up analysis and what is expected and the way you need to present your market. But a VC needs to know that your market is at least 2 or 3 billion of size, your total addressable market size. And the reason for that, imagine like in Mjoy, the case I explained you, we had an app for women and all the content was in English. So my total addressable market size would have been all the women older than 18 in English-speaking countries. That would be my TAM, okay? But then we've got something which is called the SAM, which is the serviceable addressable market size, which is actually what's more important, which would be, okay, in Mjoy, I was only focusing in the US and the UK. So my SAM would be all those women in English-speaking countries, but are only based in the US and the UK. And that figure for the SAM, I would say it should be at least 1 billion. The reason for that is that if your company goes really well, you might capture, if you're very lucky, a 5 or 10% share of that market, and that's already a lot. If you capture 5 or 10% of that market, it means that you could make 50 million or 100 million euros in turnover. For a VC, that's really important because that's like the minimum figure you need to actually go public to do an IPO or to have a meaningful exit and acquisition for over 500 million or 1 billion euros. And the reason why we need such a big exit is that Nauta has a 200 million euros fund. And I need to make sure that with one investment, I could return the 200 million to my investors at least one time. That's why we like to invest in companies that have very big market sizes. And there are ways to tweak it. We will look into it together. But if a business has a 200 million market size, maybe if it's growing a lot, this is something we could look at. But you can still have a very nice business. You can make a lot of money. I'm not saying that's a bad business. I'm just saying that it's not a business for being invested by a venture capital.
Let me cut you here, and this is something I always insist. We see a ton of people coming to us, like, I have this great idea, and they want to follow the VC path. But to me, it's like, it seems to me now that like you open a bakery in the Madrid downtown, and then like a lot of people will be asking already, like, how much cash are you burning per month? And when are you gonna do the Series A? And is it a scalable model and stuff? And in my opinion, the VC path startups should be just a small subset of all the companies out there. So I think that's a very, very important concept. Like, it doesn't mean that like whatever we're gonna cover in this presentation is not a good business. It's just like not for VC. If you want to do VC, then you have to play this game. If you want to do something else because your model demands something else, then do something else, and that's completely fine too.
I didn't include it here, but because for me it was obvious, but maybe it isn't. Usually to raise VC money, you need to be a tech company. There needs to be some sort of technological component, like a disruption. Then you need hyper growth, like companies that take VC money. This is something that we will cover here. Are companies that grow very fast. Fast means like you're tripling or doubling revenue every year, so extremely fast. And then your market needs to be really, really big. So I think that those three things are key in order to go and raise money from VCs. Otherwise, you have other providers of money, such as banks, family offices, maybe business angels, but probably not venture capitals.
Yeah, I don't meet those criteria, and I have a company that is profitable, and I'm happy with it. So yeah, absolutely.
And then another thing we really look at is something that we call founder market fit. Founder market fit links with the first advice I was giving you. For me, founder market fit is somebody who's starting a company in an industry that she or he knows really well, because he has been working in the industry for several years. He really understands the problem because he or she has suffered that problem, and they know many stakeholders, which means that you will be able probably to gain the first customers quickly. So founder market fit, in an ideal world, you want to see it. Traction, we want to see hyper growth. Ideally, there is like something that we call triple, double, and that makes reference to yearly revenue. So the first year you want to triple, the second year you want to triple, third year to double, and then Okay, that's a bit the philosophy. You don't need to meet the exact criteria, but we would never invest in a company that's growing less than 100% year over year. That's like the minimum criteria for us to start looking into a business. Then your product ideally it shouldn't be a copycat. It's something, your product is bringing something different to the market, and it has something which is substantially better than the existing solutions. This is a mistake that I see very often. When you decide that you want to start fundraising, today, for instance, we're talking to a company, we're doing like a due diligence process with a company that's already making 1 million euros in annual recurring revenue. They are raising 6 million euros. They've been around for 3 years. So this looks like a very professional company, but today they shared with me their business plan. They are raising 6 million euros, and in their business plan, I didn't see any cash needs. Like in their business plan, it seemed to me that they needed like a 500K round. So every time you go fundraising, make sure that you're raising the amount of money you need. And you can always trick the numbers to actually justify the size of the round, but it's important that your business plan makes sense with the deck and the round you're presenting to investors. It needs to be aligned, okay? And then
there's a question regarding the growth that you mentioned that Lior asked. He says, but how do you see this growth if you invest in a seed round? And this is true. Like many times VCs that invest in early stage, they demand a lot, and then the company is like, yeah, I'm just starting.
We usually, if we do pre-revenue deals, which is unlikely, we start investing in companies that make 10K monthly recurring revenue. It is true that we don't have data to see if they've tripled, but we want to see like, okay, in 3 months, maybe, or 4 months, they have onboarded 5 clients, or they have this amount of pilots. It is true that this would be more meaningful probably for seed plus or Series A rounds. So in the case that you're pre-revenue, funds will be looking a lot into the team. That's going to be the most important things. They're going to look a lot at the validation you've done of the problem. That's going to be key. Like, okay, how do you know there is a problem out there? Show me all the interviews you've done with potential customers, etc. And ideally, if you have already like letter of intents, pilots, and so on, that's what an investor will take into account at that stage.
Great. Again, the more sounds, the better, if you guys ask.
Yeah. And then, of course, you need to take into account that every VC round usually will dilute you and the existing shareholders on average 20%. So anything between 15 and 30%, these are things that we've seen. At Nauta, we always lead rounds, and we like to take something in the range of 20%. We can go down to 17 or up to 22%. But I've seen many founders doing a fundraising round, going through all the process, and suddenly saying, hey, no, I just wanted to dilute myself by 10%. And that's rather strange. And then you need to be ready to institutionalize your company. There will be a new shareholders agreement. It's very likely that if you bring a seed or a Series A VC, that there will be a board. You will start to do reportings, auditing. You will have veto rights, etc. So there are many things that you need to be aware of, but I think this is a discussion for another time. Maybe, Jaime, if you're okay, we can dive into, what a deck should have.
Perfect.
Okay, perfect. In an ideal world, it doesn't matter if you're not based in the US or the UK, if you're based in Germany, France, or in Spain. Ideally, we like to see decks in English. It's like a common practice. So we don't see founders doing it in Spanish and in English. You just do the deck in English. Be aware of spelling mistakes. It's funny I'm saying this because most likely the presentation I have, like the autocorrect, it might have many spelling mistakes, but be aware of spelling mistakes. I don't think a deck should be done to be read. That would be more an investment memorandum or something like that. I think a deck should be quite graphical, and it's something that visually you need to understand many things. So the less text, the better. Use graphics, use product pictures, tables, and then, of course, there will be some text, use some bullet points and so on. But I would avoid, as much as I could, like putting heavy paragraphs with text. Highlight your strengths. If you have like a great organic acquisition strategy that should appear many times in your deck, do not lie or avoid obvious bad data. For instance, in your deck, you should always show, according to me, I'll tell you next what we want to see, but what's your customer acquisition cost, or what's your revenue growth? If I see a company that is not showing that data point, I am already thinking that they are trying to hide something bad. So I would always encourage you to include all the data that is expected to be there. And if it's some bad data, maybe you can try to defend that weakness. For instance, if your customer acquisition cost went really badly 1 month, you can always put like a small bullet point saying, okay, this was due to a marketing campaign that failed, or an influencer marketing campaign that didn't work out for us. You can always give an explanation of why that figure is bad, but I would never try to hide things, because we see many companies, and I can already sense if somebody is trying to hide things, and that's going to be the first question I make you when I talk to you.
Yeah, and that, by the way, we see many founders that are like, when we're preparing the deck, that they think that's terrible. And to me, it's like, do you really think that there's a single company out there, like, without pros and cons? Even like Facebook, like, if you were going to invest in Series A, I can name 1,000 cons, including that they didn't have revenue, by the way, at the time. So it's like, but yet the key word here, in my opinion, is defend. You need to have a story for that. Like, yes, but this is how we're gonna cope with it, or yes, but this is why we think that X, Y, and Z.
And it's also fine to say that this is bad, or this is something I don't know. Like, when you're investing in early stage companies, there are still many risks or many things that are unknown. And we like founders being transparent, because you see that they are self-aware, which for us is very important. And second thing, this is a partnership, right? If we end up investing in your company, we will try to figure out those things together, right? But the moment you see somebody's not being transparent with you, I tend to shy away from people. So you don't have to have a perfect business. The shorter, the better. A deck shouldn't be longer, in my opinion, than 22, 24 slides. I would say that's the absolute maximum. An advice I tend to give to founders is that maybe I would have a shorter version, maybe 10 or 12 slides. That's the first document I would distribute with funds. Analysts of funds can review that. And with 10, 12 slides, they can already decide if they want to have a first call with you. And in the first call, you can then present an extended version. And if there is interest, you can share the extended version afterwards. But maybe a VC doesn't need to have like a lot of detail to decide if they want to have a first call with you. And maybe oversharing at the very beginning, like having a slide saying, I want to hire 30 engineers with a round I'm raising. Maybe as an investor, if I see that information without talking to you, I would think, okay, you're crazy. I don't want to talk to you. So if you can have like a shorter version prepared just for funds to figure out whether or not they want to talk to you, I'm going to tell you which things I think are key. And then you can have an extended version for a first call and for sharing afterwards. Take into account that the first person reviewing the deck is going to be an intern, most likely. That intern has studied computer science or business administration. They came just out of university, and maybe they've been working in the fund for only 1 month. They know nothing, okay? So you need to make things very simple. Like if you were making things for somebody, not saying I was going to say stupid, that's not politically correct because they are not stupid, but somebody you should assume that the fund doesn't know anything about you do. So make it really, really, really easy. Some things that the analyst would look for, like in a first screening in the 2 minutes or 3 minutes that Jaime was mentioning, it's okay, what's the job to be done? What's the problem? What's the solution? How big is the market? What's the traction of the company? And what's the round size they are raising? Because as I told you, in Nauta, we invest 1 to 5 million euros. So if I'm already seeing that a company is raising 200K, I already know that's too small for me. And most likely I will tell them, hey, maybe I can provide some intros if I think it's interesting, but let's talk again in 18 months because we're not the right fund for you. So these are the things that an analyst will try to find in a 22 slides deck in 2 minutes to figure out if it's a fit for us and if we want to have a call. Unlike what most people think, I don't think the deck needs to be pretty. I think the deck needs to be easy to understand, but it doesn't need to be pretty. I don't care if your graphic design is awesome or if it isn't, I don't care. And one thing I always recommend is actually writing down before creating a PowerPoint or a Miro, whatever you use. Create a Word document or a Google Docs and actually start writing. Slide one is going to be an executive summary. These are the main bullet points that I want to get across. Slide 2, the problem. I would always start by writing it down in a Word document. With that Word document, you can socialize it with your co-founders, maybe an investor who wants to help you out. And once you have that, you can start creating a PowerPoint presentation. That's something that has worked really well for me in the past with my company and with other founders.
We also have one question in the chat. Well, I had a private one, by the way, that said whether the recording will be available. And yes, we'll upload it probably tomorrow to YouTube. And then another question from Asier is about valuations. I guess we'll get there later, but I don't want to leave like any question unanswered in case we don't have time. So they say, Andrea, what do you think is a fair pre-seed, pre-money valuation for a deep tech company with 250 to 300K ARR and strong IP and team? And how different it would be in Europe and the US? I guess then there's like long discussion on many more questions. But I guess like a rule of thumb or a ballpark number.
I have like a whole presentation of 1 hour about valuations, but to give some answers, like the average seed round in Q4 last year, which is stated in the Atomico state of the art. It's an amazing document. In the US, the median valuation for a seed round was just below $12 million. And in Europe, it was about $6 million, okay? So the US is almost double what we see in Europe. And at Nauta, what really drives your valuation when your metrics are still low and you cannot apply a multiple to those metrics because it doesn't make much sense, the amount of money you are raising, it's what actually drives your valuation. So if your company needs 1 million euros and a thumb of rule is that you want to dilute the team by 25%, it would mean that your valuation is 4 million. And that's it. That's the reality of how valuations are done in early stage companies. And then if you have an amazing team with product market fit, there can always be a buffer or some extra, and instead of diluting yourself at 25%, maybe you can bring it down to a 22%. But when there are no metrics, the driver of valuation is the amount of money your business needs and the dilution you want to assume and the ownership that the fund wants in your company.
Thank you for admitting it. A lot of clients come to us saying like, we want to know the valuation of our startup, thinking that we are going to crunch their numbers in a huge Excel file that it will take 2 days to compute and then get a figure that goes to the cents. And to me, it's like, no, it's an output, not an input here. So like the dilution, the amount of money you need, and if the other person buys it, they go through. So yeah, thank you for being clear on that.
It's very random because honestly, your company isn't worth anything right now, right? It's just, it's all about like the future value of the company, right? But valuations, people think that we spend hours with an Excel sheet and so on, and no, it's not like that.
Absolutely. Perfect. Well, we just have another question. Does the number of founders have any impact for the VC? Do they have a preference for 1, 2, 3, or more founders? Are any potential startups discarded by VCs because they're run by lone founders or a 2-founder team?
No, we never discard. I think that 2 or 3 co-founders are always better. We do not discard. We've never discarded a solo founder company. When we see a solo founder company, we try to make sure if the company has it already, that's perfect, that they are surrounded by a very strong management team of senior people that are not maybe not co-founders, not even late co-founders, but that they are surrounded by a sound team. And if they don't have that yet, we try to build it with the companies. Also, we have founders that are married to each other, that some fans say, okay, this is a bit strange. We don't care. We have many siblings who are co-founders together in the portfolio. So it is true that more than 3, I would be a bit more scared of more than 3 co-founders, because I don't think that more than 3 co-founders will have enough equity to be incentivized enough. but a solo founder, and if he or she is surrounded by a good management team, we would never say no to a company because of that.
Please go ahead.
Perfect. So you can make a screenshot of this. I know Jaime is going to upload it, but this is a very exhaustive list. This isn't what you need to do in a first deck. This is actually a guideline that we share with all the companies that Nauta has done a business due diligence with. And this is what we tell them they need to include in the deck they are going to present to Nauta's investment committee. And after that investment committee, Nauta decides whether we give a term sheet to companies, right? So here in these guidelines, you see a lot of information, because based on this presentation, partners who haven't seen the startup before are going to make an investment decision, okay? So your deck doesn't need to be that complete, but you can always take it as inspiration. And I'm going to tell you like what are the main things that need to be there for sure. But this is what we request for founders pitching to our investment committee. And now I will go one by one with examples, okay? But before I do that, I would tell you that these 6 points, and maybe this doesn't need to translate into 6 slides, maybe this can be the 10 or 12 slides I was mentioning at the beginning. This is the must-have. Like every pitch deck should have these. These are the main things that our analyst is going to come and tell me, Andrea, this business is interesting because of these 6 things. We won't mention any other things before we decide if we want to have a first call with you or meeting with you. So of course, the team. Who's the team? Do they have the relevant skills and backgrounds? I told you, ideally, in my special case, I prefer a founder who hasn't gone to business school, who hasn't worked at McKinsey, but that has been working in the industry for a very long time and really understands the pain. Having said that, if you have another type of founder who has worked at McKinsey and not in the industry or in VC, that's also a relevant experience. And we also like those type of founders, okay? But the team slide is super important. The problem slide. You would be surprised of how many decks we review that after having spent 5 or 6 minutes like reading the solution, the whole deck, I still don't understand what the company is doing. I still don't understand what problem is being solved and what's the solution. And that's dramatic, because unless you have a crazy traction, I will discard the deck, because I will say, okay, I don't know what these guys are doing, and that's really bad. And this is my case, but an analyst is even worse. I've been doing VC for 5 years. I've had my company for 5 years, and there are still things I don't understand. But somebody who's coming out of university, that's even worse, right? So the problem slide needs to be super clear. What is the problem? How do you know it's a problem? And maybe who needs a solution to the problem. I'm going to show you an example of a problem slide in a minute. What's your solution? So how are you solving that problem? The market, as I was mentioning, we need to see figures in the billions of euros. And one thing that I would advise you, because when we are getting started, you don't focus on a very big market. Usually you go to a niche first, you create something to a small amount or a group of users or clients that are something very niche. Once you have that, you start expanding and growing your market over time. So a way to represent that in a transparent way could be to show the market with 3 different circles. For instance, the first circle could be, okay, this is my total addressable market size today, because I'm looking for product market fit with this long hanging fruit of clients. This is like phase number 1 in this year and the coming year. Then phase number 2, I'm going to grow from SMBs to mid-market, or I'm going to grow in number of countries. So it's fine to show the market like in different phases or circles, because it's sometimes unrealistic to show a $3 billion market or a $10 billion market when you're getting started and you're actually focusing only in, I don't know, retailers with 5 stores in Barcelona. That's actually really small, and that's fine, because that's how you need to get started. Then we're going to look for traction. What are your main KPIs? I'm going to give you examples now. And what's your go-to-market strategy? How do you acquire customers? Have you done a similar strategy in the past? Or is this something that you've been already doing in the current company for several years, and it's already something that's somehow standardized, and we're going to give you more money, and you're going to put more money into a machine that's working, and it's going to, like, the euros you put will result in revenue. Okay. And lastly, we will look for the amount you're raising to see if you fall within our range. These are the main things that an analyst will try to find in your deck, even though here there are many other things that you can include and that you should include. But these are the things that we will look at to decide if, okay, this is relevant to us or this isn't.
Great.
So,
by the way, when you talk about the team, you said that you prefer someone that has been working extensively in the industry. This is something that I'm finding, maybe I don't have enough sample, but that is very different across countries. So in Germany, most of our clients and even the leads we have are people that are 50 years old, and many times that they work at the university. That happens very often, or they have been working at a certain industry forever and now they started. Whereas in Spain, it's much more common, I guess, a stereotypical very young founder. And of course, there are success stories in both places. But yeah, I see on that, at least from our experience, very, very different depending on the market.
We also see that, and we have many portfolio companies, and we talk to many portfolio companies that do not have the founder market fit that I just detailed. But having started my own company, I realize now more than ever of how important that is, because this is going to make sure that you actually know there is a problem. Like you are going to be 100% sure that there is a problem in the market, and your go-to-market strategy might be easier because you already know how to sell to, what are the dynamics of the market, etc. But if you are clever or lucky enough to find a problem that is relevant, you have nice tailwinds in your market, you can also grow a very, very big company and be an amazing founder, even though you don't have experience in the industry. 100%. As if you want to start a company, another thing I would do if I want to start a company again and I don't know a problem, I don't come from an industry, I will try to find a co-founder who has that knowledge, and I will try to partner with her or with him. That's maybe a way I would think of starting a company in the future again.
Yeah, I would say that if you lack that experience, either like to have that co-founder, of course, it would help. But also there must be a very explicit and clear why now. Like many people are like, I'm trying to solve the airline industry that has been in existence for like 120 years. And you have like this huge problem that they have, and you have never worked at that. Like maybe it's not that easy to solve. Like there must be a crazy clear why now. It's like, okay, now we have this technology that I know a lot of. And then now it's the point, and in this industry, they could apply it. But yeah, like otherwise, I think it's an exercise of humility to many people. Like, okay, a lot of people have been given a lot of thought to this problem. So if they didn't get to the solution yet with the old technology, maybe it's for Darwinism. Maybe.
So with MJ, for instance, I had a terrible founder market fit. Like I had been in VC, but I didn't have any sex therapy background. I hadn't done any therapy with anybody. The only fit I had was that I was a woman, and that was the only fit I had with the problem. That's why we brought to the team, as a late co-founder, if you wish, like a sex therapist. You can always try and bring that industry knowledge somehow if you don't have that. But it's important that somebody in your team has it. Also at the very beginning, from my point of view. And if that's not the founding team, it can always be an industry expert that you can bring in as an advisor maybe, or as a full-time member of your team. A way to start a deck. You can start with an executive summary, which is not needed, but for me, it's a great way to give an overview so that somebody can see very quickly what you are doing, how much money you're raising, and what are like the main KPIs of your business. I'll show you an example. Well, I can show you now. This is an example that I stole from you, Jaime. Hopefully it's fine. Basically here, this is like the first slide of this company where you can see, okay, this company is within the textile industry. They say they spotted a blue ocean. They want to be the main smart clothing player. They are raising X amount of money. This is how much they've grown. These are their LTV to CAC ratio. So very quickly, you can see, okay, this is something for me. or it isn't, or it's a nice landing into the story of the company. This isn't mandatory. It's just a fine thing to do. Another thing which is a fine thing to do is starting with a vision and mission example, which is always something a bit aspirational. We see this very often. I see more decks that start with a vision and a mission rather than with an executive summary. If you start with the vision and mission option, you need to make it easy, because this is like the first contact that an investor is having with what you are doing. So you don't need to become very, very complex. Just a reminder, the vision is super aspirational. Why do you exist, right? In MJ's case, we wanted all women to have access to sexual education and sexual therapy. That was our aspiration. And the mission of a company is actually what you do in your day-to-day to achieve that. So in our case, we wanted to create a safe space where women can improve their sexual well-being throughout their life stages, menstruation, pregnancy, menopause, by learning, exploring, and unleashing their fantasies through audio content. This is what we do. And if you start like this, it's good because you make it aspirational, and somebody, if in this case, if I was a female investor, I would probably click with this vision. And this is something that it's always good to start being aligned, but you need to keep it simple, because otherwise you already start confusing people from the very beginning. The next slide, for me, is the most important, one of the most important slides of the deck.
Sorry, Andrea, before
Yeah.
getting there, there's a question that is, what do you think is the most important piece of information to make sure that your objectives as a VC are being met by making the invest or not invest decision? So I guess if you need to like just name one, I guess it's alignment with your investment thesis, I would say, or?
Yes, because the investment thesis already has everything: B2B SaaS, raising between 1 and 5, growing X amount %. That could be. It's the founding team, the market size, and the traction. I would say those three things, and all three things are equally important. In my case, but this is something very personal. I think that we were solving a real problem. The traction of MJoy the first few years was quite okay. I think the team was okay. What killed us was the market, because overnight there was like a shift, a regulation, and it happened to all our competitors that we couldn't advertise anymore. So after this experience, and this is 100% biased, I think the market is one of the most important things. If you have a market with good momentum that's pulling from you, I've seen very normal teams with very normal products and solutions making a lot of money. And I've seen very good teams with amazing products in a bad market environment not succeeding. So for me, after my biased experience, the market is super important. So the problem slide, you need to make sure that it's super clear, that somebody who's reading your deck that doesn't know anything about your industry understands quickly the problem you're solving. And for me, I would always try to give a figure, a percentage, a number. This isn't a market sizing, but it's already important to quantify the problem. In our case, we said, okay, the problem is that 40% of women have a sexual dysfunction. Okay, that's a problem. The next step for me to explain a problem is, how do you know this is a problem, right? Like what I was telling you, is this a solution in search of a problem, or is this a real problem and you know this problem exists? In our case, the second step, I was telling you, okay, we have interviewed 1,000 women with sexual dysfunctions, and only 20% of those women considered going to therapy. And the reason why only 20% of women considered going to therapy is because they were embarrassed of speaking aloud their sexual well-being problems or sexual dysfunctions, and because they thought therapy was too expensive. So for me, it's always good to highlight what you're doing with a figure and to explain how come you know that's a problem, if that makes sense. I don't know, Jaime, if you have like because I know that you already teach about how to do decks at your academy and so on. Maybe you have like a different insight about the problem slide.
Yeah, I like it in terms of style. I like the 3 points approach. I think it's very compelling, and I always say as well the numbers thing. It's not like many people. No, it's like, okay, show me that here there's stuff. And I would say as well that they show that the problem fits the customer of the product. And this is more important than it seems. So for example, I've seen slides that are like, this is a huge environmental problem. And to me, it's like, I agree. I agree that this is a huge environmental problem. But like, is it a problem for the customer? You know, if you tell me like the reputation of the customer is at stake, so they want to solve that environmental problem, it's a different story. You know, but many times it's a problem and it's like, okay, that's sad. But not so much like, is anyone willing to pay for this? So like, it really needs to show the willingness to pay of the true customer here.
This is super true. And this is one of the problems we also had in MJoy. For instance, okay, we knew that 40% of women had a sexual dysfunction, that 80% of those women were a potential target to us because they didn't want to go to therapy. But one thing that we didn't realize until a few years during our journey is that even though 40% of women had a sexual dysfunction, a lot of women had normalized it and they didn't think it was a problem. So sorry, I'm being very direct, but women who didn't have orgasms, women that didn't want to sleep with their partners in years, and they thought, okay, this is normal. And if you think this is normal, you're not going to look for solutions to solve that problem of yours. So as you were saying, Jaime, it's not only about willingness to pay. We had willingness to pay of the people that were aware that they had a problem and that they were looking for solutions. The real problem we had is that a lot of women with sexual dysfunctions, that I would tell you they have a sexual dysfunctions, they didn't consider they had one. So that was something that seems very obvious, but it wasn't when we got started. And that makes your market much smaller, actually, because it's not 40% of women with sexual dysfunctions, maybe it's 5%.
Nice. Absolutely. By the way, there's a question as well. How often do you see a startup talking to you as a VC because they have chosen, in your case, Nauta in particular, to be part of the journey, instead of a startup just going like, I need money?
You've got both. You've got both. But the people who tell you, I'm talking to Nauta because I want you, I think that's unrealistic. This is something that happens. No, it's true. I think it's companies talking to you because they want money and they are going to talk to many investors. And I think that's fine. At Nauta, we try to make founders fall in love with us during the due diligence process, because I will try to add a lot of value. I don't want to take many hours away from you without giving something back in return. So I feel that founders tend to choose us if we're competing with other VCs after we've done a due diligence. But at the very beginning, it is true that I think Nauta is positioned as a B2B SaaS fund, and people want to talk to us because of that. But I think there are many other funds that know about B2B SaaS, right? So I don't know if I answered the question.
It makes sense.
The solution and the product. So the solution slide is, in an ideal world, it should be very linked to the product slide. It should be like a reflection, no? Like, okay, 40% of women have a sexual dysfunction, only 20% seek therapy because the rest are embarrassed of doing so and it's too expensive. Okay, my solution is a sexual well-being app, which is anonymous, so you don't need to be embarrassed anymore, and it's way cheaper than the current solutions, which is going to therapy. That would be a good solution slide. This is the solution slide we had. And honestly, looking at this, I think it's a pretty bad solution slide right now, because the title is fine. MJoy is a sexual well-being app for women with 1,000+ audio sessions, but the rest, it looks more to me like an executive summary now than a solution slide, because I'm telling you, okay, we're an app and we've been in the market since 2020. I tell you the amount of users we have, where are they based? I tell you about my business model and the amount of money I've raised. So that looks more like an executive summary. So I think that now maybe I would have included the first sentence and I would have answered to the problem slide. I would have said, women are not embarrassed because we're an app which they can access in an anonymous way. And second, we're not as expensive as therapy. And that would have been a good solution slide for me now. I don't know, Jaime, if you think in a similar way.
Yeah, I always say the word, the reflection part. It's like, okay, you should talk directly to the three signs of a problem that you mentioned in the brief. So it's like, okay, the problem is that exactly they don't do it for reason A, then this is B, and so exactly like that. I like the reflection part. I wouldn't say it's too bad. It's true that it shows more traction and the numbers and stuff, but in this one in particular. But yeah, this certainly should mimic the problem slide.
And then if we continue, you will always have to show product slides. And here I would encourage you to add a few screenshots of your product. If you don't have a product, I would advise you to create an MVP in Figma or something like that, that you can show wireframes at least, even though there isn't a product out there. I would advise you to include graphics, like showing your product, and this is something I didn't have and something that now I really want to see, and I really appreciate if it's there, a short link at the bottom that is a short demo that I can click and it takes me to YouTube, your webpage, whatever it is, and I can see a short product demo of 2 to 5 minutes, because that's what's really going to give me the understanding of what you're doing.
By the way, regarding solution, I always like as well when they can give me numbers as well on the solution. It's like, okay, 80% of our clients' cost, we have been cut, or like 95%, 95 NPS, something like that, like some numbers that show that you're solving the problem, not just like that you are trying, but like you're solving it.
That's great. It's like the ROI, like now, because of this, like, I don't know, instead of having 3 people in the company, you can use my software and you're saving this headcount, and that's the ROI, right?
Mm-hmm. Yeah, absolutely.
Then I'm going to continue because market size and ideal customer profile, as I was telling you, in our case, this is what we did. We did 2 circles, as I was telling you. First, phase 1, what's the first thing we're focusing on, and phase 2, a bottom-up analysis. If Jaime shares with you the slides that I don't have a problem with, here you have an Excel basically of how to do this. It's very simple. It's basically trying to quantify your universe of customers. In our case, women above 18 years old, who have sexual dysfunctions and who are based in the US and the UK. And maybe I could have had more things like, this is going to be used by women who are in cities because they are more open-minded. So you can always narrow more the market and trying to find your ideal customer profile, and you will multiply this by your average contract value per year. Okay, what's the revenue I will make in a year from that customer? And you just multiply those figures, and that's your serviceable addressable market or your total addressable market, depending on the universe you're taking. Here, important, as I was telling you, the total addressable market size, you need to show something huge, at least 2 or 3 billion, and something that you can justify with figures, that you can share with me an Excel where I can see your universe of companies, how you have thought about that universe, and maybe your current pricing, and that's an addressable market size today. And maybe you can project that you're going to increase your pricing in the next 5 years, and you can show me like a new market size in the coming years, because your pricing is going to be higher. And this is very linked, and this is something that you also need to show with your ideal customer profile. Okay, you need to tell me who your ideal customer profile is to do the market size calculations. Sorry. So in this case, you can have a type of customers 1, for instance. We just did a travel tech investment. In here, what I'm covering is actually travel management companies. So an ideal customer profile in the range from 2024 to 2026 are travel management companies that are making between 500 million and 10 billion in GMV, based in the US and in Europe. And within this range, there are 700 companies out there. So this is something that we always advise you to include, so that to make sure that we understand the customers you want to target, even though you don't have customers today. And it's always good to include what's your go-to-market strategy. In this case, I just wrote down, we do enterprise sales. Right now we're getting started, so it's founder-led. We will hire a VP of sales and a sales manager. We will work with distribution partners, and we attend events to generate leads. If you're a consumer company, you can show, okay, I'm spending 10,000 euros on performance marketing every month. 20% is in Google, 80% is in 60% is in Meta, and the 20% remaining is influencer marketing. That would be a way to
it's
show
already 7. It's already 7. Fine for me to continue like 15, 20 more minutes. Absolutely. And I hope that for many people, or in any case, it will be YouTube tomorrow. But just to remind you of the time.
Perfect. I have 15 more minutes, Jaime, if I can keep going.
Perfect. Absolutely. I think it's been great.
Then, after the market and your ideal customer profile, you should talk about competition. Competition, we tend to see 2 or 3 slides maximum. The first slide or the first 2 slides are about positioning, like, okay, in the universe of competing players, where do you stand? Where are you placed? And I'm going to show you 2 examples. One, which was MJ's example, that I think it's pretty bad, because I'm not saying anything. I'm saying, okay, I'm in the intersection of sexual well-being and audioerotica. Here you have these players doing this and that. But in an ideal world, the way we like to see the positioning of companies towards their competition is in a matrix, in a 2x matrix. And in the matrix, you can include different things, but what we tend to see are product features. Okay, here's product feature A, here is product feature B, and I map all the universe of competitors depending on where they stand on the different product features or axes I've chosen. And I would always advise you should always appear on the top right. No matter what you choose, you should be on the top right. And in this example, which I also stole from you, Jaime, I tend to see many matrices like competitor positioning that to me do not make any sense. So it's important that you pick things that somebody who's not from your industry can look at and say, okay, for me, this makes sense. In this case, here, this person has mapped the universe by sustainable processes versus 20th century process. What the hell does that mean, right? So to me, this isn't like the slide is great because you've positioned the players, you appear here, but the product features or the features this person has chosen are a bit strange to me. Like, it's not telling me much. Okay, so I would advise you to include things that make sense and somebody who's coming from outside can read it and understand it. In this slide, even though it's very graphical how you stand out, it's always good to include 1, 2, or 3 bullet points highlighting in words how you stand out. Maybe it's highlighting what we already see in the graph, or maybe it's adding some additional information. After this graph, what we like to see usually is a table. Okay, now that you've mapped the competition, I want to know more information about these companies, like where are they based? For how long have they been around? You can write a short description if you want or not. How much VC money have these companies raised? And what's the size of the companies? And if you don't find revenue figures, sometimes it's available, but if you don't find revenue figures, maybe employee count or traffic to their website with SEMrush or different tools can give you already an indication about size, which is relevant for us to understand how big these players are. And if you're like in a new space, a new emergent space, like in our case, or now we're looking at maybe climate tech companies that do, carbon offsetting or carbon accounting, etc. Since this is a relatively new industry, I would advise you to include a mix of legacy players. Maybe the legacy players are consultants or tech competitors that have been around for 50 years. I would always include a part of legacy players, and these people need to be making a lot of money because these are the people that you're going to steal from. So it's important that I can see that there are very big companies that are super obsolete, that are super slow, making millions and millions and millions of euros, that you can appear with something which is 10 times better than they have and steal customers from them. So I always like to see very big legacy players. And you could include both legacy and direct competitors who can be new entrants to the market. You need to talk about your business model. This is very simple. You can have a screenshot of your pricing plan on your webpage, or if it's more complicated, detail it here. But here we see, okay, this company has a freemium business model. You can start using their product for free. Then I can see that they have monthly and yearly subscriptions. Ideally, maybe I would have liked to see, okay, what's the split between monthly and yearly subscriptions? But I feel that this slide is good enough. You just need to explain how you make money. This is important. Like maybe it's advertising, affiliate marketing, maybe it's a B2B SaaS with subscription, maybe you're selling a device, or I don't know, or a table. I don't care what it is, but I need to understand how you make money. Traction and KPIs. So for the traction and KPIs slide, you can show this in a table. You can have a slide with different figures. It's up to you. My advice is that it's very visual. And here, usually you can mix different things. We tend to see companies that mix KPIs with P&L and cash figures. So data that can be relevant and that you can include, it's revenue, monthly recurring revenue. What's your lifetime value? What's your customer acquisition cost? You could have, I haven't written it here, but what's your customer acquisition cost? Payback. What's the churn? Gross margin? How much money you're burning? What's the year-on-year revenue growth? There are like certain, depending on your business. If you're a marketplace, GMV is going to be a very important figure. If you're a B2C subscription app like Mjoy, maybe your retention figures and your engagement within the app is something that is going to be relevant. So depending on the business, something might be relevant. In our example here, I showed, okay, this is super old, but at that moment in time, we had 80,000 registered users. I was very proud of having 35% of organic installs, which is bad actually, but I was very proud and I put it there. We have 3,000 paying users, 10K of monthly recurring revenue. This is my CAC, this is my burn. So there are different metrics that might be important depending on your business, that this is a way to present it. You can include graphs like this one. Okay, this is the amount of paying users. This is where we are today. And these are my projections. So you can do it in different ways. But VCs want to see like the picture of today. Okay, what's the current picture of your current metrics and how much you've grown? That's also important because we are looking for hyper growth. So if you make my life simple and you tell me how much you've grown, we're going to save each other a lot of time. Because if you don't show that and I go into a call with you and I ask you that question, that's something that I know it's not going to be for us or for another PC, right? That's why I mentioned that it's good to be upfront from the very beginning. And then, of course, we also like to see projections, but I have that a bit later. I wanted to show you the team. The first slide, I advise to have 2 slides for the team. The first one is showing the founders and explaining why the experience of the founders is relevant. If it's the founder market fit thing I was telling you, because they are coming from the industry, maybe it's because you've been working at great consultancy companies, maybe it's because you're a second, third time founder, whatever it is, highlight the relevant experience of the founding team or the key management team, depending. I wouldn't show more than 5 or 6 people, I would say here, with the key experience. Advisors, you can include them if they are relevant. If not, it's fine not to include them. And then in Nauta, we like to see a slide, which is not always a common practice, but I'm sharing with you what we also like, which is a slide like this one. This is the team of Danelfin, which is an investment we just did. I asked for permission to use this slide. And this is basically, okay, this is the founder, this is the management that is here today. These are the different team members that are in the company today, but I'm also seeing the org chart until 2024. So I'm seeing the people they want to hire with our round. And that's something we ask companies that present to the investment committee to present. So show me an org chart with pictures or blue with the people that's already in the team. And then maybe in a different color, the people you want to hire in the future. Fundraising and projections. Okay, for fundraising, I would always advise, hold on, I'm going to change seats because the sun is killing me. I would always advise you to give a range, okay? So if you do your business plan and you realize that your cash needs are 2.5, let's say, I would always try to put a range which isn't too big because otherwise it seems that you don't know what you need. But I would always give a range because if you say from 2 to 3 or 4 to 5 or 1 to 2, you can talk to smaller funds that could be happy with leading or investing in a 2 million round. And you can also talk to more late stage or Series A funds that their smallest ticket is 3 million. So you open up the universe of investors by giving a range. So and another advice would be, if it's always better to start with a lower end of the round, like it's better to say, okay, I want to raise 2 million and end up raising 3 because there was oversubscription and a lot of interest, and saying that you want to raise 5, there is no interest in bringing it down to 3. Because if you start a fundraising with, I want to fundraise 5 million euros, and you have to bring it down to 3 and then go back to the VCs, hey guys, I know I told you 5, but actually it's 3. It's like a bad signaling somehow. So I would always try to say, try to go with a lower range, because you can always make it higher. The other perspective of starting higher and going lower looks worse, in my opinion. And try to give a small range to open up the universe. Do not include the valuation. I know valuation is important to you, and it's important, but it's up to the fund to determine the valuation. And it's strange, but funds don't like companies putting the valuation. You can say it when you're talking to the fund in more advanced discussions, and I wouldn't advise you to tell a valuation number. I would always discuss a dilution range that you feel comfortable with. Like, okay, depending on the amount we're raising, we're happy with diluting ourselves 15 or 20%. If you've raised previous funding, you can include that. What are you going to do with the money? You should always show, okay, with this money, what's the split? How am I going to split it between tech, marketing, and operations? And with this money, where is this money taking me? If I have a runway of 24 months with a round, what's the picture in 24 months from now? Like, where is it taking me in terms of headcount, revenue, number of clients? I'll show you now. So this is a slide we have at Nauta that we share with founders before the IC. An example of, okay, a slide funding history would be, okay, this is the previous round I did. I raised 2 million in October 2022. We were 8 people. We had 10 customers, etc. This is what we're raising right now. We're raising now 5. The team has grown. The number of customers has grown. And I'm already thinking about the Series A. So I think that in 3 years from now, this is, if you don't think you need a Series A round, that's not needed, but many companies need it. And it's nice for us to see how a founder is already thinking about the future. And that is actually the milestones we need to hit in the coming year and a half, 2 years, or 2 years and a half. Another way to present this. This is another way you can do that. In this case, the company said, okay, in terms of round, this is the amount I've raised already. This is what I'm asking for, around $3 million, which will give me over 2 years of runway. This is how I'm going to split the round. Tech is going to be the biggest expense, 55%. And then to the right, you have the projections of the company. Okay, today, this is the current picture. I'm making 10K of monthly recurring revenue. I have 3 clients. This is where I want to be in December 24, December 25, and December 26, which is the time frame you have to actually make use of the money you're raising. This is a slide we created recently with a company pitching to the IC that I really liked. Other ways of showing this, in MJoy, I'm raising 2.5 to 3 million for the next 24 months. This is the split, and this is how I'm going to look like once I've spent your money. In terms of users, I will have this amount of users. In terms of go-to-market, I will have opened up new countries. My organic traffic is going to be more. My product is going to be more complete, and I will be at 150K of monthly recurring revenue. That's another way to present it. And to finish, so if you meet the investment thesis of the fund, the next step will be to pitch your idea and to have a meeting. Some funds will give you 45 or 60 minutes, but be ready to present it in 30, because many times you will only get 30 minutes. My advice would be that you follow the deck structure, and also do not assume that the team has read your deck. They should have. I always read the decks, but maybe somebody in the team hasn't read it. So you need to start from the very beginning, assuming they don't know anything about your company. I would tell you to be ready to make a short product demo of 3 to 5 minutes. This is another advice. if you're fundraising, you should talk to at least 50 or 60 funds to get 1 to 3 term sheets. Okay, I know that's crazy, but that's how big your universe of VCs should be. And I always categorize VCs in tier 1 and tier 2. Tier 2 are the VCs that I thought were less interesting for me. And I always try to talk to tier 2 VCs first to gather feedback, see if there are things from the deck they don't understand or from my pitch. And that's how I could tailor and improve my pitch so that when I presented MJOY to tier 1 investors, I was a bit more ready. If you can have a small data room with basic information ready, such as your cap table, business plan, market size, it's always great because after a first call, you can share the longer version of the deck and already give the investor access to very basic information that they will need to decide whether they continue with conversations. And the last advice is something I've already tell you. I think it's good to start with a shorter deck so that the VC can decide if they are interested in having a first meeting with you. And if they are, you can share the longer version of the deck. And yeah, that's the presentation, Jaime.
Great. I think it was great. Thank you very much. In fact, I'm also pretty happy that we, I think, meet a lot of your criteria when we recommend startups on how to build their business deck. So thank you everyone for connecting. Feel free to reach out Andrea or me through LinkedIn or by email. I mean, I'll write it in the chat here. But feel free to reach out to us. Certainly, if you guys have B2B SaaS company that meet those criteria, Nauta is one of the best and oldest VCs, more experienced in Spain, but they invest in the whole Europe. And then, yeah, like any help with the VC, like preparing for a VC funding round, any help with all the finance area and stuff, you can contact us. And also, by the way, we have much more content like this in YouTube, and also we have our training course, the Startup Academy, that you can also look up in our website. So, well, again, thank you very much, Andrea. Super cool. I think it's one of the best webinars and with a lot of content and a lot of strong messages. So thank you very much for your time again. And thank you everyone for connecting.
Thank you for having me. Bye. Have a nice afternoon.
Bye.
Thank you.